On November 6, 2023, WeWork filed for Chapter 11 bankruptcy in New Jersey. That sentence sounds simple, but it hides one of the wildest collapses in modern business history. Just 4 years earlier, this company was valued at $47 billion. Investors called it the future of work. Founders called it a movement. But behind the glass walls, free drinks and spiritual slogans, WeWork was carrying a business model that could only survive if the fantasy never stopped growing. WeWork's promise sounded brilliant. Rent office space from landlords, redesign it beautifully, and sublease desks to freelancers, startups, and growing companies. Simple, flexible, modern. But the pitch went far beyond office rentals. WeWork sold itself as a technology platform, a lifestyle brand, and even a social revolution. That is what made the story dangerous. Investors were not just buying desks. They were buying belief. At the center of the empire was Adam Neumann. He was not a quiet real estate operator. He was tall, charismatic, intense, and almost hypnotic when he spoke. He could turn an ordinary lease into a spiritual mission. He told people WeWork was going to elevate the world's consciousness. It sounded absurd to critics, but to investors searching for the next giant startup, it sounded like vision. Neumann was born in Israel and later moved to New York City with one clear ambition. He wanted to get rich. Before WeWork, his business ideas were strange and unsuccessful. One involved collapsible women's shoes. Another was Crawlers, a baby clothing brand with padded knees for crawling infants. These ideas failed to become major businesses, but they revealed something important. Neumann could sell strange ideas with total confidence. Then Neumann met Miguel McKelvey, an architect with a different background but a similar interest in community and shared space. In 2008, they convinced their landlord to let them convert vacant floors into an eco-friendly co-working space called GreenDesk. It was not yet WeWork, but the ingredients were there. Unused real estate, flexible tenants, stylish interiors, and the feeling that work could be sold as a lifestyle. GreenDesk worked well enough that Neumann and McKelvey sold their stake back to the landlord for $500,000 each. Then, in 2010, they launched WeWork. Their first location opened at 154 Grand Street in Soho, Manhattan. Before the company had even opened its doors, Neumann convinced real estate developer Joel Schreiber to invest $15 million for a 33% stake. The valuation was already $45 million before the machine had truly started. The real business was arbitrage. WeWork signed long-term leases from landlords, redesigned the space, then rented smaller units to customers on shorter terms. If the building stayed full, WeWork could collect more per square foot than it paid. That was the trick. But the trick came with a hidden time bomb. Long-term obligations on one side, short-term customer commitments on the other. That mismatch was the heart of the danger. WeWork had fixed lease commitments that stretched years into the future, while many customers could cancel quickly. In a boom, that model looks flexible and genius. In a downturn, it becomes brutal. The customers leave first. The bills stay behind. And when the bills are measured in tens of billions, flexibility turns into a trap. WeWork also pushed density hard. Traditional offices might give workers around 150 square feet each. WeWork could pack far more people into the same floor, sometimes targeting 50 to 60 square feet per person. That made the revenue look stronger. More bodies meant more memberships. More memberships meant better numbers. But it also meant the model depended on constant demand and very little margin for weakness. Neumann understood something investors sometimes forget. The label on a business can change its valuation. A normal real estate company might trade at a modest multiple of revenue, but a technology platform could be valued like a rocket ship. So WeWork became space as a service. It became a physical social network. The words changed first, then the valuation followed. Venture capital loved the story. Benchmark invested early. Wall Street names like JPMorgan Chase and Goldman Sachs helped push WeWork's valuation higher. By 2014, WeWork had crossed the billion-dollar mark. It became a unicorn. But the unicorn label was more than a milestone. It became a weapon. The bigger the valuation became, the easier it was to convince people the company must be special. Then came Masayoshi Son, the billionaire founder of SoftBank. Son had raised the $100 billion Vision Fund and wanted companies that could dominate entire industries. In late 2016, he met Neumann, toured WeWork, and saw exactly the kind of ambition he liked. A normal investor might have asked about lease risk. Son wanted something bigger. He wanted WeWork to move faster. The meeting became startup mythology. After a short tour, Son reportedly invited Neumann into his car, pulled out an iPad, and sketched terms for a $4.4 billion investment. He told Neumann that being crazy was good, but that he was not being crazy enough. That sentence became rocket fuel. It encouraged WeWork to behave not like a business looking for discipline, but like a movement chasing world domination. Over the next 2 years, SoftBank poured more than $10 billion into WeWork. By January 2019, the valuation reached $47 billion. The number was breathtaking. But breathtaking is not the same as rational. The valuation assumed WeWork was not just renting office space. It assumed WeWork could become a global platform controlling how people worked, lived, learned, and gathered. To see how strange that valuation was, compare WeWork to IWG, formerly Regus. IWG had thousands of locations, millions of members, and actual profit. Public markets valued it at only a few $1 billion. WeWork had fewer locations, far fewer members, and lost nearly $2 billion in 2018. Yet private investors valued WeWork at $47 billion. That was not valuation. That was hypnosis. With SoftBank money flowing, discipline disappeared. WeWork expanded aggressively across cities, signed leases at speed, hired thousands, and spent like a company that believed capital would always be available. But when cheap money is everywhere, bad decisions can hide in plain sight. Losses become ambition, waste becomes culture, and warning signs are dismissed as negativity. Whenever investors visited, employees were reportedly told to activate the space. That meant creating the appearance of energy, food, drinks, people, noise, movement. The office had to feel alive. But that is the problem with stage momentum. It becomes hard to tell where the real demand ends and the performance begins. WeWork was not only renting offices, it was producing theatre. Adam Neumann's lifestyle became part of the legend. WeWork bought a $63 million Gulfstream G650 private jet. The founder was known for party energy, grand speeches, and behavior that blurred the line between visionary confidence and reckless entitlement. Inside the company, the founder myth grew larger than the financial reality. That is dangerous, because when a company becomes centered on one personality, the numbers often become secondary. Then came the side projects. WeWork bought Meetup. It invested in WeLive, a co-living concept. It launched WeGrow, an expensive school inside company headquarters. It even acquired a wave pool company. Some of these ideas may have sounded connected to community, but together they revealed a company losing focus. WeWork was trying to become everything before proving it could profit from its core business. The culture became stranger. WeWork announced a company-wide meat spending ban, yet Neumann was reportedly seen eating meat himself. Summer camp retreats featured alcohol, celebrity performers, and startup party excess. Employees worked exhausting hours, often accepting lower pay because they believed their stock options would one day make them rich. The dream was expensive, and the people closest to it were not always the ones who would get paid. By mid-2019, WeWork needed the public markets. It was burning cash too quickly to keep relying on private hype. The IPO was supposed to be the moment WeWork became undeniable. Instead, it became the moment outsiders finally saw inside the machine. Private investors had funded the story. Public investors wanted the numbers, and the numbers were about to destroy the story. In August 2019, WeWork filed its S-1 registration statement under the internal codename Project Wingspan. The filing did not read like a normal financial document. It opened with language about the energy of we and a mission to elevate the world's consciousness. In a founder speech, that might sound inspiring. In an IPO filing full of massive losses, it sounded alarming. Then came the financial reality. In 2018, WeWork generated about $1.8 billion in revenue and lost about $1.9 billion. That means it lost more than it brought in. Another way to frame it, the company was losing roughly $3,000 every minute. The dream looked beautiful in office lobbies. On paper, it looked like a furnace-burning investor money. To soften the losses, WeWork promoted a custom metric called community-adjusted EBITDA. It stripped out major real costs like rent, utilities, and marketing. Critics mocked it as earnings before all the bad stuff. That phrase cut through the nonsense because it exposed the game. If a company removes the expenses that make the business exist, almost anything can look profitable. The S1 also revealed self-dealing. Neumann personally owned stakes in buildings that lease space back to WeWork, meaning he could collect rent from the company he controlled. That is the kind of detail public investors hate. It raises a simple question: is the founder building for shareholders or building a machine that pays himself first? Then came the "we" trademark scandal. Neumann had trademarked the word "we" through a private entity and sold it back to WeWork for $5.9 million. The public reaction was immediate outrage. The deal was later reversed, but the damage was done. It made the company look less like a revolution and more like a founder-controlled cash machine. Investors also learned that Neumann had already cashed out hundreds of millions of dollars before the IPO through stock sales and loans. That changed the emotional meaning of the story. Founders usually ask investors to believe because they are fully committed. But when the founder has already taken huge money off the table, outsiders start wondering whether they are buying the dream after the dreamer already got paid. The IPO collapsed in slow motion. Bankers cut the possible valuation from $47 billion toward $20 billion, then lower, and eventually near $10 billion. Public investors were saying no. They did not believe the story at the old price. They did not trust the governance. They did not accept the fantasy accounting. The private market spell was breaking in public. In September 2019, Adam Neumann stepped down as CEO under pressure from SoftBank and the board. But his exit was not ordinary. SoftBank gave him a massive package reportedly worth nearly $1.7 billion, including consulting fees, share purchases, and credit support. The founder who helped create the crisis was leaving with a fortune. The employees were not so lucky. Weeks later, WeWork laid off about 2,400 employees, roughly 20% of its workforce. Many workers had accepted intense workloads and lower salaries because they believed their stock options would make them wealthy. Instead, the dream evaporated. This is one of the ugliest patterns in startup history. Founders monetized the vision, while workers absorbed the collapse. In early 2020, WeWork brought in real estate veteran Sandeep Mathrani to stabilize the company. His job was not mystical, it was practical. Cut costs, sell non-core assets, renegotiate leases, and focus on survival. In other words, WeWork finally needed boring management. The problem was that the company had spent years building obligations during the exciting phase. Cleanup would be far harder than storytelling. Then COVID hit. The pandemic attacked the exact weakness inside WeWork's model. Month-to-month members could cancel quickly. But WeWork still owed landlords under long-term leases. Remote work exploded. Offices emptied. Demand collapsed. The flexibility WeWork had marketed to customers became a weapon against the company itself. Customers could escape the buildings. WeWork could not escape the lease contracts. This is the brutal lesson of mismatch risk. On the surface, WeWork looked flexible. Underneath, it was rigid. It sold customers optionality while keeping the liability for itself. That can work when demand is booming and capital is cheap. But when the economy changes, the structure flips. The advantage becomes the weakness. The selling point becomes the wound. In 2021, WeWork finally went public through a SPAC merger with Boaks Acquisition Corp. At a reduced valuation of about $9 billion. That was still a major number, but compared with $47 billion, it was a humiliation. The market had repriced the story. The dream was still alive, but smaller, weaker, and far less believable. The post-SPAC years did not fix the core problem. Remote work remained powerful, interest rates rose, money became more expensive, growth companies lost their magic in public markets, WeWork's cash burn continued, and the lease burden stayed heavy. The company could no longer rely on the old formula: raise more money, open more locations, tell a bigger story. Now the math had taken control. On November 6th, 2023, the bankruptcy finally arrived. The company, once valued at $47 billion, entered Chapter 11 to restructure its debts and leases. It was a stunning fall, but it was not sudden. The collapse had been built into the model for years. Long leases, short-term tenants, heavy losses, founder control, loose governance, cheap money. When those pieces were stacked together, bankruptcy was not a surprise. It was the final invoice. In May 2024, WeWork emerged from bankruptcy after eliminating about $4 billion in debt and cancelling or amending more than 300 leases. Control shifted to Yardi Systems alongside SoftBank, and John Santora became CEO. The company survived, but not as the empire once promised. It emerged smaller, humbled, and stripped of the mythology that had made it famous. During the bankruptcy process, Neumann even tried to buy WeWork back with a reported $500 million offer. Creditors rejected it. That detail feels almost unreal. The founder who built the myth, lost control, and walked away with enormous money wanted another shot at the wreckage. But this time, the people holding the broken company were not buying the pitch. And yet, Adam Neumann's story did not end there. In 2022, Andreessen Horowitz invested $350 million into his new residential real estate startup, Flow, reportedly valuing it at $1 billion before it even launched. That is the final twist. In venture capital, failure does not always end the founder myth. Sometimes, if the story is strong enough, the money comes back. The rise and fall of WeWork is not just about one company. It is about an era when cheap money, charismatic founders, and venture capital hype blurred the line between business and belief. WeWork was a real estate middleman dressed as a technology revolution. For a while, the costume worked, but eventually the market asked the one question every fantasy fears: does the math actually work? And when that question was answered, a $47 billion empire collapsed. Thanks for watching. Like, comment, and subscribe. If you enjoyed the story of the rise and fall of WeWork, how a $47 billion empire collapsed, then you'll love the story of the fall of Credit Suisse, how a 167-year-old banking giant collapsed. Click the video on your screen now. I'll see you there.